Market regulator, the Securities and Exchange Board of India, SEBI, has cracked down again on the F&O segment, introducing 7 measures to curb increased retail activity. This was outlined in its consultation paper. One of the key points that SEBI highlighted was that approximately 92 lakh unique individuals and proprietorship firms incurred cumulative loss of approximately 51,600 crore in financial year 2024. Only around 15% of the traders, approximately 14 lakh, made net profits, which means that 85 out of 100 made a net trading loss. In contrast, larger non-individual players like HFTs, algo traders and FPIs have generally made offsetting profits, the paper highlighted. Let's try and understand the 7 proposed tighter derivative measures. First, SEBI has proposed reduction in number of weekly option contracts to 1 benchmark index per exchange, which means there will be total of 6 weekly contracts in a month versus 18 currently. In contrast, if we look at monthly contracts with expiries in the 4th week of the month, they will continue as it is status quo. Other measures included by SEBI were: members must collect option premiums on an upfront basis from clients. There will be elimination of margin benefits for calendar spread positions, intraday monitoring of position limits, and the 5th point includes increase in the minimum contract value of the index derivatives. What does this mean? It means that minimum contract size for index derivative contract is to be revised in a phased manner. First phase will include minimum value of derivative contracts at the time of introduction to be between 15 to 20 lakhs. And the second phase, which would be after 6 months, the minimum value of the derivative contracts will be between the interval of 20 to 30 lakhs. Now, the 6th point that SEBI introduced was the increase in the extreme loss margin on the day before expiry, which is expiry minus 1 day, and on the day of expiry. As per the consultation paper, at the start of the day before expiry, extreme loss margin ELM will be increased by 3%, while at the start of the expiry day, ELM will be further increased by 5%. Lastly, there will also be rationalization of option strikes. For short duration contracts, providing wide range of strike prices scatters liquidity and causes volatile price movements. This also facilitates artificial trades in illiquid strikes at very low premium. Therefore, SEBI has proposed to have uniform strike prices interval up to 4% of the range of underlying price, and increased strike price interval beyond 4%, and strike price revision to be carried out will be on daily basis. Further, there will be max 50 strikes, 25 each for put and call, to be introduced at the contract launch. This would enable SEBI to restrict the speculative volumes which were seen in out-of-the-money contracts. Now, how will this impact the market? At an overall level, the measure of the reduction of the number of weekly contracts will have the highest impact as per the brokerages. According to the foreign brokerage firm Jefferies, SEBI's proposed F&O measures will remove 12 out of the 18 option contracts and impact approximately 35% of the industry premiums. The report also highlights that currently weekly premiums, which is weeks 1 to 3, make up approximately 65% of the overall industry premiums, and depending on the choice of one index by the exchanges, Jefferies believes that supply of contracts amounting to approximately 35% of the industry premiums will be removed by this measure. In terms of spillover activity, as per Jefferies, the spillover trading activity, if from these measures of curbing the weekly options into 2 continuing products, will limit the impact to 20 to 25% for the system. The report has also highlighted that there will be divergent impact on market players. Exchange and retail focused brokers are expected to be most affected by the introduction of these measures. Clearing members like Nuvama that cater to institutional players, HFTs, FPIs will be less impacted but may see some second order effects. Jefferies has also highlighted that in terms of ranking of the highest impact will be seen on discount brokers like Zerodha, Angel One and exchanges, and retail focused traditional brokers like Motilal Oswal, IIFL, Securities will also see some impact from the introduction of these measures. When looking at the exchanges in terms of earnings impact for exchanges, NSE will be the most affected as options account for approximately 60% of its revenue in financial year 2025, while for BSE it is approximately 40%, said IIFL. Further, BSE is also expected to gain from spillover activity as NSE has more weekly option contract activities. This has led to its EPS upgrade by many brokerages, and hence the stock has been trading up 7% after the announcement.